This crisis poses huge challenges, it also presents us with significant opportunities. Most of the challenges require urgent, decisive action. The opportunities may take longer to harvest. Our short-term actions must lay the basis for sustainable and equitable growth in future. The European Union response to the crisis has been very significant, and rightly so. Central banks have cut interest rates to historically low levels and provided huge amounts of liquidity to the financial system. Some of them have even embarked on non-orthodox measures to provide credit to the economy. European governments have channeled massive support to their banking systems through guarantees and recapitalization. Let me just give you some figures. Since October 2008, the European Commission has approved a total of 3.6 trillion euros, equivalent to 30.5% of GDP, of state aid measures to financial institutions. So far, 1.5 trillion euros, around 12.6% of GDP, have been effectively used under the four main headings of debt guarantees, which account for the largest part of the support, recapitalization, liquidity support, and the treatment of impaired assets. This has been done in a coordinated fashion, following guidelines issued by the European Commission. As regards the so-called real economy, the Commission proposed a European Recovery Plan in November last year, which received full endorsement from the European Council and included a significant and coordinated fiscal stimulus. Its implementation is on track. The overall fiscal effort, including automatic stabilizers, will amount to 5 to 6% of GDP in 2009-2010. This response has avoided a financial meltdown and prevented a major decline in economic activity. Indeed, the Commission's latest estimates show that while European Union GDP continued to decrease in the second quarter of this year, the pace of contraction slowed. In some countries, GDP data for the second quarter were positive. Nevertheless, and as expected, economic activity will contract this year in the European Union. The unemployment rate will reach 2 digits and unfortunately will keep on rising for some time, even once growth has returned. As we all know, labor market developments always lag behind those in the economy, both when the economic outlook is deteriorating and when it is recovering. Indeed, unemployment started to increase only in the second part of last year, a good year after the crisis started. The Commission has been strongly focused on unemployment since the beginning of the crisis, because also for social reasons, this is the most important, most serious threat I think we are now facing in Europe, unemployment. Indeed, this unemployment issue has been our #1 priority. The European Recovery Plan includes and advocates measures to maintain and increase employment. We have been careful to design these measures so that they are reversible and do not create the wrong incentives. The recent recovery spots are fragile and do not allow for any complacency. In any case, it is clear that global growth will not return to pre-crisis levels for some time. Those growth rates and economic model behind them were simply not sustainable. This has been dramatically illustrated by recent events. With unemployment increasing, investment down, some production capacities destroyed, the crisis will leave the European Union with subdued growth potential. So at microeconomic level, the priority at the current juncture is to continue to sustain overall demand. This means maintaining the monetary policy stance, continuing to implement the European Recovery Plan, and maintaining government support for the banking sector. It is clearly too early to withdraw support for the economy and financial sector. Identifying the right time to exit requires deep analytical work. The task is particularly difficult because it relies on the quantification of unobserved variables like potential output and the output gap. In addition, it must be coordinated at international level, particularly in the G20, of which the European Commission, as you know, is now a full member. And indeed, we were at the origin of creating this process at global level. However, we must already prepare our exit strategy. The best course is to provide the support needed today and commit ourselves to tough and clear targets tomorrow. That way, we can reassure the markets that the entirely warranted increases in government debt will be reversed at some point without endangering our recovery. Happily, in Europe, we are well placed to do this. Our fiscal policies are well anchored in the revised Stability and Growth Pact, which provides a stable, medium-term framework and is also sufficiently flexible. Most importantly, it provides for flexibility in the setting of deadlines for the correction of excessive deficits. Due to a combination of cyclical factors and discretionary action, most member states will have a government deficit well above 3% of GDP this year, an excessive deficit in the jargon of the treaty. These deficits must be corrected, but this must be done in an intelligent way using the flexibility allowed by the pact. In most cases, bringing the deficit below 3% will take some time. The deadline should not be the same for all member states and should aim at avoiding procyclicality, though this may not apply in member states where the imbalances are such that fiscal adjustment is a matter of urgency. This is the case particularly in those member states which are receiving balance of payments assistance. Ladies and gentlemen, there is also work to do in securing the robustness of the European Union financial sector. If we want to restore growth on a durable basis, the first priority is to get bank credit flowing again. In order to land, banks must be in a sound position. Some will need additional capital. It is vital to know the concrete situation of each bank, in particular the large banking groups with significant cross-border activities, in order to assess whether or not this is the case. The Commission will therefore continue to encourage stress testing for the systemically important banks. Stress tests should be based on commonly agreed European Union parameters so that the results are comparable. It will then be up to member states to decide what to do with the results of the stress test. Stress tests are not a panacea. As important is to deal rapidly with impaired assets on banks' balance sheets in cases where this is relevant. The Commission issued guidelines on this. Interestingly, however, only a few member states have made use of them. This suggests that impaired assets are not, in fact, a widespread problem in the European Union.